Today, we're going to talk to you about tax diversification and retirement. Really, where do we expect our taxes to go as we enter our retirement years, and then ultimately, what are some things we can do to help reduce our tax liabilities? So, jumping in here. Okay, jumping in here again. Okay, so today I'll be presenting. As I said, my name is Chase Tushaus. Partner with Tushaus Wealth Management. We have offices in Scottsdale, Arizona, and San Diego and Liberty Station here. We are full service tax planning, financial planning, and investment management firm. The way we view taxes is, it's not just enough to do the tax plan. We want to come up with a plan. Then throughout the year, we want to execute the plan. So that's tax management. And then at the end of the year, we do tax preparation as a way to look back to say, okay, did we do everything that we needed to do, right? And so with that, to have that expertise to talk about taxes, I'm an enrolled agent designation with the IRS. Pretty much it just says that I can talk about taxes with you as it relates to also your financial plan, your investments, all that together. I'm also a licensed fiduciary, registered investment advisor. So legally bound to do what's in your best interest. And so the other presenter you see on the screen here, Kirk Tesshouse, one of the other partners, also doubles as my father. So, but today you just have me. So let's get rolling in here. So today's agenda. So we are going to talk about the 6 fundamental financial planning considerations. So through our experience and some of the risks and challenges that we help people work through, we've kind of summed it up into 6 primary planning considerations, or another way to think about that or look at that is, what are the 6 planning risks to your retirement? We'll also talk about understanding the impact of taxes on our retirement income and why we feel that risk is only going to be more significant as we go forward. So then from there, it's not all just bad news here, right? Because our tax future doesn't look great, but we want to talk about strategies for how can we help mitigate that? How do we help reduce our taxes, especially as we go into these retirement years? So question here, what do you believe are some of the greatest risks to your financial future? So here are those 6 fundamental financial planning considerations. So the first one's longevity. I guess an easy way to think about that is, am I going to outlive my assets? Truthfully, it's a little bit deeper than that. It's not just not running out of money, but rather as we live older, what additional expenses can we expect? A lot of those obviously related to healthcare and long-term care. And you're watching this and thinking like, hey, there's no chance I'm making it, past 80 or 85 or whatever that might be. But I've told families we've worked with who sat down with us, and they tell me that they're like, hey, I'm leaving at 85. And I said, well, what happens if you come in and now you're 86? Like we have to have a plan for that. So considering that, and then also, I was at a conference recently. We were talking about healthcare and retirement. And something I found interesting that we talked about was, average life expectancy for a male in the US is mid 70s, right? Well, if a man makes it to 65 years old, his new life expectancy is actually as far out as 89 years old. And for a female, if they make it to 65, our new life expectancy is actually 91. So when you think about that, when you think about the advancements in healthcare and where we're going from that perspective, it kind of makes sense that like, yeah, maybe we need to be planning out to ages like 95 and 100, which we're seeing more and more commonly. So the second one is liquidity, making sure we have funds for the expenses, whether they're planned or unplanned, when we need those funds. The other one is inflation. Okay, so over a 20-year period, the Federal Reserve, the inflation target is at 2%, but at no point in history have we consistently stayed at 2% inflation. And so right now, if we were to have, that consistent 2% inflation, something that costs $1 today is going to cost almost $1.50 in that 20-year span. So, and we know oftentimes inflation is more than that 2%. So how do we plan ahead, look to that, and how to address it? Market. So really the volatility, we've worked so hard to accumulate and save and invest. And so we have we have these great assets, but now how do we make sure we protect those assets? But then again, continue to allow them to grow, doing what we can to avoid losses and still within a certain risk profile, be able to then meet some of the expenses and needs we've been talking about. The fifth one here, mortality. So this might be something, like what happens to me if something happens to my spouse. If I'm receiving spousal benefits through Social Security and, my spouse is earning more in Social Security benefits than I am, and they pass, and that's great. I get to receive their benefits, so I get to step up. But at the same time, I just lost that additional Social Security income that we had been receiving. Or, one that's maybe a little less common is something commonly referred to as the widow's tax. So when you're married, you get to file your taxes. Your tax status is married filing jointly, and that is it's a preferred rate. The tax brackets are, the range is a little bit better. And so when we file as a single filer, then now ultimately we could be making the same amount of money as we were before, but our taxes, we might fall in a higher tax bracket. So trying to understand that pension income or their survivor benefits, those sorts of things. And then of course, the reason you're, listening to this is taxes, right? And I'm going to go through now and try to show you why we should be concerned about our tax rates potentially going up in the future. So for our firm and for our process, what we do is really try to understand, we can't just look at one of these financial risks, but really we need to see how all these are working together. And ultimately, if we lay out the pieces of your financial plan, how can we put these together in an efficient way to help address these risks? So going forward here, so what is tax risk? It's the risk of decreasing retirement income as a result of increasing future tax rates. So let's understand this a little bit further. So I'm going to use an analogy here. We're going to use a 30-year mortgage. So we're going to go buy a house. We're going to finance it. So let's say we found a house, and well, I'm here in San Diego, so we found a house for $1 million. I don't know where I'd go to find a $1 million house in San Diego, but let's say we're going to finance that. So we're going to borrow $750,000 today, and that's going to be our mortgage. And over 30 years, we're going to pay that back. But the bank is not going to tell us what our interest rate is until the end of the loan. So would you be willing to take that loan? So you're going to pay the principal down, and at the end of the 30 years, they're going to be like, okay, by the way, your interest rate was 15%. Okay, well, you're going to owe a lot of money in interest, right? So no, we wouldn't be willing to take that loan. So every time we invest money into a tax qualified plan, so think about your like a traditional IRA or a 401k, these employer sponsored plans, 403bs, 457s, TSPs, all of those sorts of plans. You're kind of taking a similar risk. And what you're saying is, maybe we aren't necessarily saving on taxes today because we get to put that money in tax-free in the current year, but we're just delaying the taxes and kind of kicking that tax can down the road. So we have to be asking ourselves, what do we anticipate? Are we going to have to pay more in taxes later on than we're paying now? And that's really ultimately the game to tax planning is pay taxes at the lowest rate possible, right? So now kind of taking it another step further here. So what's driving our concern around taxes? And so you might be familiar with this, and it really goes down to what our nation's debt is. So back in 2008, our national debt was a little over $9 trillion. That sounds like a lot of money, but as you can see, and we progress forward here, in February 2020, our nation's debt had almost tripled at that point. So we were over $23 trillion. And then as early as January of 2025, our national debt was over $36 trillion. So you can see the way we're going right now, it's we're definitely not paying our debt down. So before we really kind of talk about how this applies to us, it's good to, I just threw out several trillion dollars at you, but really what does a trillion mean? We used to say billion, and that used to mean something. Now billion is kind of like a rounding error. So let's try to wrap our minds around like what's $1 trillion or what is a trillion. So in a single day, there's 86,400 seconds. There are over 31.5 million seconds in a year. So what year was it 1 trillion seconds ago? So I'm sure you're going to pause this and think through that, but 1 trillion seconds ago, it was 30,000 BC. So that's over 32,000 years ago. It was 1 trillion seconds. So another way to think about that is you would need to spend over $31.5 million per year for over 32,000 years to spend $1 trillion. And as of the recording of this, I think our nation's debt is getting close to $38 trillion. So it's kind of feeling like a little bit of a runaway train, right? So there's two ways to counteract debt, right? I don't care if it's for you personally, our nation's debt, our businesses, whatever that might be. We either need to reduce spending, right, to bring down our debt, or we need to increase revenue. And if you think about it, the way our nation has kind of been spending money, it doesn't seem like no matter which political party is in power, that we have the appetite to be reducing our spending right now. So have we as a country reduced our spending? Absolutely not. So let's look at our nation's debt from the 1920s until kind of present day. And what you'll see is that for a while there, we kept it low, and then we had this hockey stick moment, right? Where, if this was a stock chart, this would be a great stock to own, right? But unfortunately, it's our national debt. And so this is where we're seeing, we're getting above that $37 trillion mark. So why could this matter to you? Why does, these numbers, we hear them all the time, we hear it increasing, but why should you care about any of that? Well, it's a good question. So what we're going to look at here is a graph of, it's a ratio of our nation's debt. So how much are we borrowing compared to our nation's GDP, or how much as a nation do we produce? And so this ratio of debt to GDP is an interesting one because in some ways it can tell us about the health of our economy. So when we are borrowing more than we are making as a company, what you'll see is that our nation's debt to GDP ratio goes over 100%. So there's points here where we'll see it was kind of in the mid 40s, 1940s, where you see the nation's debt to GDP ratio go over 100%. But when you think about that time, our nation was in a war, right? We were in this big war. We needed to pay for it. And so we were borrowing a lot more than we were producing. But what you see after that is the graph starts to come back down again, right? Until we get into the 80s. And then it was around that point where we see then the debt start to go back up. And what we see current day is that our debt to GDP ratio is over 120%. So we are borrowing a lot more than what we are making when you compare the two. So this red line chart that you see now here, what we're seeing is what was for our individual tax rates, personal tax rates, what was the highest marginal rate at that time period? And we're going to use this as a comparison to see when debt to GDP ratios were really high, where were our tax rates at? Because, maybe we weren't necessarily reducing spending enough, but we were increasing our revenue to be able to pay that down, right? And so there's a period of time, kind of the 1940s and 50s, where over a 30-year period, we saw 16 years of those 30 years, our highest marginal tax rates were in the 90% or close to it. And when you think about that, that's like, okay, you make $1 and you're only going to walk away with 10 cents or less. That's a lot in taxes. Sometimes it feels right now like our taxes are pretty high, but when we look at the history of our nation, maybe it's relatively not as high as we think, right? So you see the tax rates are high, and then they start to come down through the 80s and 90s. And over the last 20, 30 years, our highest marginal tax brackets have stayed relatively low compared to previous years. So you can look at this and you could say, on one hand, we have some of the highest debt to GDP ratio we've ever seen. And on the other hand, our tax rates are at some of the lower rates we've seen, right? So why should we be concerned? Well, if we're as a nation not going to be reducing our spending, then that means there's only one path to pay down our national debt. And at some point, this will need to be addressed. Maybe it's in the next couple of years, maybe in the next 5, 10, 15 years. But at some point, especially when we look at like longevity and retirement, we might be living in retirement for, we might have these 20, 30-year retirements. So at some point, it's realistic to expect that we could potentially have our tax rates increased. So a little rhetorical here, but when problems are ignored, do they tend to become larger or smaller? Well, obvious, become larger. So think about if you had a pipe in your house and it was going to burst, and you did nothing about it. You either did not know it was a problem, or you didn't know that there were solutions, right? You didn't know that you could do something about it. And so the good news with all this is that we're going to walk through some strategies to help you figure out. We now know that there's a tax problem. So how can we help mitigate this? How can we help reduce our taxes? So I know we're all kind of at, maybe watching this, we have different backgrounds, different levels of education when it comes to taxes and how all this works. So some of this I'm going to start, just laying the foundation. Parts of it we're going to get a little bit more advanced, but ultimately I hope that as we go through these strategies, you'll be able to pull some value out of that. So to begin, let's just start with by talking through the three types of retirement income. So we have our tax now bucket, our tax later bucket, and our tax free bucket. So tax now, that's like income generated from Social Security, dividends and interest, pensions, capital gains. So it's money that as I earn it in this year, I'm going to have to pay taxes on in this year as well. Tax later, so that's our traditional or rollover IRAs, 401ks, 403bs, 457s, all those employer sponsored plans. That is money that, I put in, I have not paid taxes on. It's growing tax deferred. And then ultimately, when I pull it out, I'm going to have to pay taxes later at that date. And then there's our tax-free bucket. So this might be income that's generated from muni bonds or money that we might pull from our Roth IRAs. And so we're gonna talk about traditional versus Roth retirement accounts in a few slides here, but ultimately any money that comes out of those sources, I've either already paid taxes on or do not owe taxes on it. So going forward here, one concept I want to throw out here is tax diversification. So, most of us typically have our investments are in one type of these. Let me back up just one second. They're in one of these buckets, right? Typically, that's mostly the tax later bucket. But uh, when we talk about tax diversification, we're interested in making sure our assets are diversified between the three buckets because at different times we might want to pull income and maybe not either have to pay taxes or have already paid taxes on it, just kind of depending on what our expense goals and needs are. So similar to like investment diversification, I could argue at one point, 60-40 stock to bond portfolio was a well diversified portfolio. I'm sure there's plenty of literature out there that would tell you one way or another, but we would say that that was a well-diversified portfolio. A tax diversification portfolio, a lot of us, like I was saying, sit in this 100% tax later bucket, or a majority of our assets might be in our 401k or IRA. So they sit in the tax later bucket. Whereas a more well-diversified tax structure might have some of that money in the tax later bucket, some of that in the tax now bucket, some of it in the tax-free bucket. And then ultimately, when things come up, whether they're planned for or not, we now have options as far as where do we want to pull that income from. So as I mentioned, I want to explain the difference between traditional versus Roth IRAs or 401ks. When I say IRA or 401k or qualified plan, I'm kind of, for the sake of this presentation, we're just talking about the same thing. It's a retirement account, and there's kind of two ways that we can look at it. There's, the IRS gave us the option. They made us this deal where they wanted to encourage us to save for our own retirements. And we would do that through either we got to make this choice of either not paying taxes now, letting our investments grow, and then as we pull money out later on, paying taxes then, or we pay our taxes now at our current rate, and then that money would grow tax free and then ultimately be able to pull those funds tax free. So really the question then becomes, should you pay your taxes now or later, right? So if we decide to delay our taxes, are we really saving taxes today, or are we just simply pushing taxes to a rate where, or pushing our income to a tax rate that we might not know what that is, right? So if we think about that mortgage analogy, you're waiting till the end, and then you're going to pull your tax rates out when the mortgage company, in this case, the IRS, tells you, okay, your tax rate is going to be, X amount, and you were hoping for Y amount, right? The one thing to even go a step further and consider is that, with the mortgage, it's tied to a home, and as the value of your home goes up, it's not like the mortgage goes up with it, right? Proportionately. In fact, if you're paying your mortgage, the mortgage rate is going to go, or your mortgage value is going to go down. Whereas when you think about this mortgage or this lien or the taxes that you're going to have to pay from your traditional IRA, as the value of your IRA goes up, that percentage, it's a percent, the tax is a percentage of what that amount is. your mortgage, if you will, is going to also increase with it. So there's no other asset like that where all of a sudden like our liability is increasing as our as the value of our asset increases. So you might be thinking though, well, if I'm going to have to pay all these taxes later on, I don't need the money, I just won't pull it out of my retirement, my traditional IRA. And the IRS said, hey, that's a great idea. And that's why they offer us the RMD or the required minimum distribution. So depending on the year you were born, at that age, the IRS is going to say, okay, we're going to have you each year, we're going to require that you take out a minimum amount of money so that we can, apply our taxes to it, right? So they will be able to have you pull out money, whether you need it or not, collect their tax revenue, and then, whatever is left over, you can decide, okay, maybe I'll spend it or reinvest it, whatever that might look like. So uh, this graphic that just popped up here, I like this. This was a family we'd worked with. We kind of broke out their assets into these three buckets. So you have the first one is that taxable bucket. So it's a great amount of money, $1 million in between some trust accounts. So anything we earn in that year, coming off that we recognize we'd be paying taxes on. The bucket on the far right, that $430,000, that's our Roth IRA assets. So that tax-free bucket. So we've already paid taxes on it. It's growing tax-free. Ultimately, when we pull it out, it'll be tax-free. And this middle bucket, the $3.5 million or roughly there at, those are our traditional IRAs or 401ks that we group together. They're really excited. Okay, we've done a good job. We've saved this amount, but if we're planning for retirement here, it's not like we have $3.5 million out of that bucket that is ours to utilize. But rather, when you kind of think about this, and I'm just kind of generalizing here, but let's say your tax rate's around the 25%, so only 75% of that amount is really yours. That other 25%, you owe the government. So let's just say you snapped your fingers and just feel like, you pay your 25% up front. Well, in this scenario, that's $1 million off the top that is not yours, that you would owe the government, at that moment, if it was 25% and that was the value that, through RMDs that ultimately you'd be paying, right? So I don't know about you, but that's a good amount of money that I'd rather have in my pocket if that was my account. So what can we do about it? So that's where Roth conversions come in. So this is a way to strategically move funds from your traditional IRA into your Roth IRA. And now you wouldn't necessarily take it all, pick it all up and drop it over, but this is something you want to do a little bit deeper analysis to understand, okay, how much, what is the appropriate amount that I can take out of my IRA and put into my Roth IRA, because ultimately, whatever I take out of that IRA to convert, I'm going to be paying taxes on in that year at my ordinary tax bracket. So if you are, selling some stock, you are selling your house, you've made a lot of income, you started your pension and your Social Security, and your income is now piled up, piled up, piled up. And then on top of that, you do a Roth conversion, you might be very well sending yourself into one of the higher tax brackets. So maybe that's a year where you don't consider doing a Roth conversion. But maybe the next year, that income comes down because you don't sell those assets. Well, that might be a year where you consider, okay, I'm going to fill up my tax bracket, the one I'm currently in, and doing that Roth IRA and making sure you're kind of locking in your taxes at that rate for that year. So as you put money into that Roth IRA, that money's going to grow tax free. And it's going to be pulled later on tax free as well. There are some rules you just need to make sure you abide by. The 5-year rule when it comes to putting money into a Roth IRA. And then, one thing to point out too is that this is not only a good tax planning tool, but it's also a good estate planning tool because ultimately, whether it's an IRA or a Roth IRA, let's say my dad had an IRA account, he passes, I inherit that money. I have 10 years to pull all that money out of the IRA, uh, ultimately, so that I don't just sit on that, let it grow, pass it to my daughter. She sits on it, lets it grow, right? But now the IRS can start getting some of that money out and start charging those taxes, right? Start applying those tax rates. So if it's an IRA, then I am pulling money out. It could be all in the first year, it could be it all in the last year, it could be broken up every year for the 10 years. as I pull that money out, I'm paying taxes at my ordinary tax rate. Now, if it's a Roth IRA, the same deal applies where I got to get it all out within a 10-year period of time, but the taxes have already been paid, so I'm pulling all that money out tax-free. A good thing to consider also from an estate planning perspective. So, to get a little bit more advanced here, something to consider. So, there's also opportunities to perform conversions when assets are depreciated. This could be done in many different ways in the public markets, private markets, but in this graph here is just a little example of the idea that when an asset depreciates, that might be a good time to consider doing the Roth conversion because at that time, that's when when the asset's depreciated, you're going to be paying taxes at that value there. You move it into your Roth, and then ultimately hope that over time that asset appreciates again. So there's a timing element to some of this. The strategies can get a little bit deeper, and a lot of that is understanding your situation, understanding your risk tolerance to that. Tax offsets are a way to also consider how can you help pay for some of the taxes you might owe in addition on the Roth conversions for that year. So with the most recent tax laws that have been enacted as of July 4th, 2025, there are, a few different things you can consider: bonus depreciation and cost segregation. So there's some ways in there, depending, if you meet some requirements, that you can take 100% depreciation on a real estate property in the first year. Intangible drilling costs, these oil and gas investments. So maybe that's 60 to 90% of well costs that could be deducted in the first year. Ultimately, these, if you have money invested in there, these are tax offsets that ultimately flow down to you. Other things like charitable land donations, there's a few requirements there, but so when you start pairing these things together, maybe it's a little bit of the timing, the Roth conversions, the tax offsets. That's where now you're putting together a little bit more of an advanced strategy. Kind of continuing on the charitable contribution line. So if you are charitably inclined, uh, this might be of interest to you. So, qualified charitable distributions. So, if you're at a point where you are taking your required minimum distributions, and just to back up on RMDs for a second, RMDs, it is a percentage of the value of your qualified account, your traditional IRA, if you will, on the last day of the previous year is the value that they use. They apply this percentage as a formula the IRS uses. It does increase, incrementally over the years. And then, ideally, if you're invested well, you're not pulling all your principal out, your assets within that traditional IRA are also going to grow. So you can see very quickly like that the RMDs, the amount that you're pulling out could really start to increase and increase and increase. And then on top of that, what does that mean? It's more income out, which means your taxes are also going to increase, increase, and increase. So one thing to think about, if you are, again, charitably inclined, you're taking those RMDs, but maybe you don't necessarily need that full required minimum distribution for, expenses or whatever you're going to do. One opportunity is to use the qualified charitable distribution as a way to take that RMD, have it go directly to the charity itself. There are some limitations to that, depending on if you're single or married filing jointly, what your tax status is. But it's a way to ensure that RMD income then doesn't apply to you in that year because you're using it as a charitable donation. This might also be of interest if you're already taking RMDs, but you want to continue to do Roth conversions, and you can kind of help limit some of that RMDs. Again, assuming that you've done, full financial planning and your cash flows and your income and expense needs and all that. So might be a way to help offset that to get more money into that Roth IRA through Roth conversions. Another strategy to consider here is the donor advised fund. So this might be beneficial if you are recognizing a lot of income in a single year and you want to help offset that. Again, if you're charitably inclined, it might be a way, whether it's with cash assets or non-cash assets. You can see from the chart here, what the percentage of your adjusted gross income you can actually deduct on your taxes. But what's great about this is even if you've put a good amount of money aside or you've contributed a lot of that to your donor advised fund in that single year, you can't get the full benefit recognized in that single year. This is something you can carry forward then for 5 tax years. So Now, putting money in a donor advised fund, the way that works is that you're actually removing it from your estate. You're putting into this fund, and you typically work with like another custodian who's going to actually now hold the funds and essentially have them invested. They can grow. It's not like you're giving them directly to maybe it's your church that you want to support or another nonprofit you want to support. It's not like you're giving the money to them yet. You're putting it in the fund so it can continue to grow, and then over time you can reach out to that custodian you're working with who holds your donor advised fund, and then you can request distributions be made to your charities. Now, it's important to make sure you partner with the appropriate custodian that you guys kind of see eye to eye on issues, because ultimately they could deny your request to have money sent to a charity if they felt that charity did not meet some of their standards or rules as well. So make sure if you're religious, maybe find a religious affiliated donor advised fund custodian to partner with. But just a few things to consider there, because in order to get the tax benefit, that money has to leave your estate. So now legally you don't have that control over it anymore. Okay, so real estate. So in Southern California here, a lot of the families we work with, just kind of in the Southwest here. What's the problem with rentals? There's over time we kind of get sick of these the tenants. Hey, like it's just the truth, so, right? The trash, the toilets become the three T's of rentals. But for some of us, maybe we inherited those properties. For some of us, maybe it was our first home we purchased. And maybe that was a few decades ago now. And so we've had this good appreciation in those assets in that real estate, but maybe now we're at a point in our life where we don't want to have to go over there and deal with the mold issue. We don't want to have to, be hunting down tenants to make sure they're paying rent on time, right? It's become a little bit more of a hassle. So what can we do? Because if we were to just sell it outright, we'd be recognizing a pretty large unrealized gain. And that means a pretty large tax bill, right? But there are options. And so one of those in particular, you might be familiar with the 1031 exchange, where you could go from one physical property to another physical property. But again, that's just putting us in another rental. And so the DST 1031 exchange, Delaware Statutory Trust 1031 exchange, it's a way of taking a property now, selling it, and essentially you are transferring those funds and then therefore that unrealized gain into essentially it's like a real estate investment fund. So it's you and other investors that have put money into a fund like this. It could be for condominiums. It could be for uh, industrial assets. It could be for commercial assets, whatever that might look like. But ultimately, it's a way to stay invested. You're still in real estate. You don't have to recognize those gains, and then you can kind of alleviate yourself from some of the issues when it comes to owning a physical rental property, right? And it might allow you an opportunity to invest in a property that you otherwise on your own wouldn't have enough assets to invest in. And so there's also different opportunities to provide liquidity with some of that, certain things like UPREITs and that sort of strategy. So one of the last things here I want to hit on is the gotcha taxes. So these are those little things embedded within our tax code that, as you do something over on this side, what's that ripple effect that's ultimately going to come over here and affect us on this side, right? And one of those, a big one, is the income related monthly adjustment amount. So IRMA, or the Medicare premium surcharge, common names for this. So what you're looking at here is the different thresholds. This was the Medicare Part B, D premiums for 2025. What a lot of people don't know is that the premiums, so the monthly payment you're going to pay for Part B and D in Medicare, is dependent on your income. So there's these different thresholds, and each of these different thresholds is the modified adjusted gross income, wherever you fall. So wherever your income, that Magi, wherever that falls into one of those thresholds, you can see, if you can then go across, how much extra, if any, that you'll have to pay for those Part B and D premiums. So in this example, what you see is that this individual, this couple, they fell in that second highest tier. So per month, each of the husband and the wife would need to pay an additional $400 plus for their Medicare Part B premium, and then an extra $80 or almost $80 for their Part D premium. So the thing about this is it's a 2-year look back. So this income was income from their 2023 tax return, actually. So if this is what I earned in 2023, in 2 years when I turn 2025, or in 2025 when I go to see what my premiums would be, it's going to be based on that income from that time. So, maybe you're doing Roth conversions and, you're sensitive that you don't want to move up to a higher threshold. Maybe you might limit then how much in a Roth conversion you end up doing. Now, the Medicare premium is only good for that 1 year, and then it resets again based on what your income was from then 2 years from that year. So each year, might be high 1 year, but then the next year it goes back down. So ultimately, you got to have to ask yourself, if you're doing Roth conversions and you have the opportunity to save hundreds of thousands, maybe $1 million, whatever that, it's likely it could be that high, is paying an extra couple $1,000s potentially for my Medicare premiums in a single year then worth it? So the only way we know that is to put all the information down, try to understand like what the reality is based on the current year's tax code. So there's a few other gotcha taxes we would talk about. I won't go into depth here, but there's the net investment income tax. So if you make over a certain amount, any of your investment income would have that additional 3.8% a tax added on. So I want to go into a case study here. I will say this is similar to, it's based off a family that we have worked with in the past. This is a very, I'll say, clean and like ideal situation for a Roth conversion. But the reality is, we're seeing people that are doing Roth conversions that are already taking their required minimum distributions, have already started Social Security benefits, might be receiving their pension, or different things are happening. And that's why it's important to really, consult a professional, sit down, go through to understand your situation, and then see, what the opportunity is, because there is an opportunity. It just might look different, from family to family. So let's go through this one. Mary and John here, 6-year-old couple, small pension, high net worth, so $2.4 million in that tax later bucket. So that was their combined, IRAs. What did they want? They wanted sufficient income in retirement, an ability to control their tax bracket when taking Social Security, and then ultimately required minimum distributions. And so, when you think about it, taking control of your tax bracket, when you get to that point, if your RMDs are increasing year over year, which means your tax rates are going, or your taxes owed are then going up and up and up, there's not a whole lot you can do to control what tax bracket you're going to be in, how you can maybe withhold income in 1 year and then maybe recognize it in another year. So by more effectively moving some of that money from the traditional side to the Roth side, before you get that big tax bill, that is a way that we can better control that tax bracket. So for them, so we said we gathered their information. This was through a platform we used. We were able to analyze their tax return, and we saw that currently they're sitting just at the bottom, towards the bottom third or so, bottom quarter of the 24% marginal tax bracket. And so for this year, this is where they landed. And what we noticed was, the goal or the opportunity was everything above where their income bar stops up to that 24%. So the top of the 24% tax bracket, that was the opportunity. And if year over year, if we could fill up that 24% tax bracket, we felt like that was the most effective strategy that would give us the most impact when it came to our taxes. And so, in doing this with them for a number of years, what we found is that, yes, some years we were able to hit the top of that goal, and that was great. And then some years we weren't able to. If we were selling a home or selling assets where our income without doing the Roth conversion was already up close to the top end of the 24%. Yeah, that was a year we just had to say, okay, we need to pause our Roth conversions this year, and we'll look again next year, right? The one thing to consider, with all this, like, yes, that's great to move money from your traditional to your Roth IRA, but we still have to pay taxes in the current year. So where should our tax money come from? So that the taxes, they can be paid from, income we've generated, maybe from work or pension or Social Security income, whatever that might be in the current year. It could come from taxable savings. It could potentially even come from withholdings from the transfer itself, but it's not an ideal situation because ultimately you want to get as much into the Roth IRA as you can so that you can get, over time, hopefully get that growth back to then, cover the taxes that you otherwise had to pay, right? And then from there, continue to grow tax free. So you want as much growing tax free ultimately as you can. So with them, we went through this analysis, and what we were able to find is that they had 15 years until the required minimum distribution started. And, we're essentially, we keep doing this. Within that 15 years, we'd be able to completely eliminate their required minimum distributions. So then throughout then the rest of retirement, they'd be able to, yes, they're taking Social Security, which is also a taxable income source, right? But maybe we could reduce the amount that's being taxed on Social Security. They'd have their small pension. Okay. Then when they needed money for anything else, they could be pulling it from their Roth IRA and not paying taxes on it. So as you can see that from a federal tax perspective, that lifetime tax saving is significant, $2.3 million. One thing I will point out on the left graph there, starting in the 75, you see the graph slowly come up and up and up, right? And so that's where each year that RMD amount is increasing, increasing, increasing. Whereas on the other side, you see, okay, maybe we paid a little bit more in taxes up front, but then after that, our taxes essentially, we get close to zero, if not in a few of those years. So again, a great opportunity, but we realize that not everyone's going to have a clean situation like this. There is a lot more to consider. So which strategy could, work best for you? There is, how we pull out information or how we pull out income from those different sources. So having the full distribution plan to Roth conversion strategies and charitable contribution strategies, tax offsets, all these things kind of come together, but there is some that are going to be more impactful for us than others. And so it's just a matter of going through the plan, trying to put these pieces together and effectively find a way to help reduce your lifetime taxes. So just as a reminder, we talked about those 6 fundamental financial planning concerns. So longevity, not just we don't want to outlive our assets, but what expenses are going to increase as we get older, a lot of them tied to healthcare and long-term care. Liquidity, making sure we have the money we need when we need it. Inflation, okay, we need to make sure our money isn't just sitting in a savings account, that we are making a little bit to keep up with inflation because things will cost more in the future. Market volatility, let's protect what we have, but still allow ourselves to continue to grow our assets. Mortality, what happens to us if something happens to our spouse, and of course the big one, taxes, that we talked about today. So you've seen this photo of a mountain here. If anyone knows what mountain this is Mount Everest. And an interesting fact about Mount Everest is that more people unfortunately die coming down Mount Everest than they do going up. And in a lot of ways, we kind of we look at this and we say, okay, this is kind of a good analogy to our finances, as we're approaching retirement or our high earning years and then entering retirement. And from there, one misstep on the way down could be catastrophic, right? And so by making sure that we have these appropriate tax plans in place, financial plans, investment strategies, everything that really ties together, that is our best guide down. And in a lot of ways, we as a firm, we want to make sure that this is what we are doing with the families we get to work with. So, we do that through a process called the Wealth Defender process. It's really to help identify, each of these risks that we talked about, 6 financial planning risks, but not only identify which ones apply to you or which ones are you concerned about, but also to what degree do they apply to you. And so what we want to offer, because I'm sure watching this presentation, you might think, okay, what is a next step? A next step is, you can use a link we'll provide here to sign up for a strategy session with us, an opportunity to share a little bit of your information with us in your current situation, talk through some specific questions you might have, but ultimately see if that process, the Wealth Defender process, is something we can go through together to help you identify an opportunity to maybe reduce taxes or maybe find the most efficient time to take Social Security and recognize income. Maybe we need to protect our assets more. Maybe we're taking too much risk and have concentrations in single stocks and things like that. And when it comes from to a tax perspective, we know that for a lot of tax preparers, they're inundated with a lot of tax preparation at a single time of the year. And so if you've worked with one, you know that tax planning isn't something that's always there's a focus on or talked about, right? And on the other end, for a lot of financial advisors who they just might be focused on the investments, maybe do a little bit of tax loss harvesting or something like that, I'd argue like how much tax planning is really happening there. And if we're not licensed or able to offer tax advice, then now you have kind of two sides of this equation and this big gap in the middle. So where can you fill that gap? That's where we try to fill ourselves, put ourselves to help address both of those concerns and kind of bridge all that together. So, with that, I want to thank you for joining our tax diversification retirement webinar here.